What's good, y'all? It's Alex Comunio here, and in this video, I'm gonna show y'all how to analyze a rental property. If you're new to this channel, then it's all about earning money, saving money, and investing money to achieve financial freedom. If you haven't been rocking with us and you don't know what financial freedom is, then financial freedom is the ability to live off of passive income from assets that you've invested in so that you don't have to trade in your time for money at a job. Let's get into today's video.
I guess I got my swagger back.
Now, when it comes to analyzing rental properties, this is super important and super key, because if you don't know the math and you don't know the numbers, then you will buy a liability, right? We only buy assets around here, not liabilities, right? Assets put money in your pocket, liabilities take money out of your pocket. Money Monopolizers 101. And so you really need to make sure you know the numbers. There's a saying that's common in real estate, and that's you make money when you buy. And so what that essentially means is that if you don't know that you made money on that investment the day you bought it, then that's a bad investment. And so that's why knowing the numbers and knowing how to analyze a deal is so critical to your success as a real estate investor. I'm going to show you how to make sure you're always buying something that's going to cash flow. If y'all watch my video on how rental properties make you a millionaire, then you know that cash flow is the most important thing when it comes to buying real estate. If it doesn't cash flow, throw that in the trash, leave it alone. We do not buy it if it's not cash flowing from day one. But essentially what cash flow is your income minus your expenses. So it's very key that you know how to determine income and also how to determine all your expenses. So in this video, we're gonna analyze a real life deal looking at the cash flow analysis. So we're gonna analyze a duplex that's in my local market that I literally saw on the market this morning. We're gonna look at it and analyze it to see if it'll be a good investment. So the first thing, of course, is determining the income on the property, right? And so obviously when we're talking about rental properties, income is the rent.
Well, duh.
Your rent is going to be determined by your fair market value rent in your local market, right? And so what similar properties are renting for in that area is how you can know what your property will also rent for. So there's three ways that I figure out what my rent could be. Number one, I will go to rentometer.com and I will put in the address there, and I will literally, it will show you the average rent and it'll show you the median rent. Make sure you always use the median rent, right? Because average, obviously, if you remember 5th grade math, average takes into account the outliers in that area, right? And so you don't want to be accounting for the outliers. You want to be in the middle. That's what the median is, right? Remember, mean, median, mode. Median is the middle. The second place I'll look is Zillow. And so I'll just look at the properties that are listed for rent there. Now, keep in mind that those are still listed for rent, so they're not actually haven't been rented yet. And the third place I'll look for rent is actually using a real CMA from my real estate agent. So if you have a real estate agent, you can ask them to run a CMA, which is a comparative market analysis, to determine what other properties that are similar to yours are renting. This is the most definitive method to actually determine your rent. However, obviously you need to make sure you're not just always asking a real estate agent, because you're gonna burn them out. They're never gonna wanna work with you again. And you're just gonna be that guy that asks for stuff and doesn't ever take action. In other words, you'll be a tire kicker.
This one's 14.5.
14.5?
Yeah.
Will he take 10 cash?
So in this example for this duplex, rentometer.com is telling me that a 3-bedroom, 3-bath unit is renting for about $12.95. But of course it's a duplex, so we have to multiply that times 2. Determining income isn't too difficult. Anybody can do that. Now, where people go wrong and where I see people go wrong all the time is how they determine their expenses. What typically happens with new real estate investors is that they only account for their mortgage, right? The principal, interest, taxes, insurance. And that is not your only expenses. Rent minus mortgage is not cash flow. You need to determine your true cash flow, which is going to include all the other expenses. Principal, interest, taxes, insurance, vacancies, repairs, property management, capital expenditures, lawn care, snow removal. Those are the expenses that you need to be accounting for in your analysis, right? If you do not account for those expenses, then what's gonna happen is you're gonna buy this deal, and when they actually come up, you're gonna have realized you bought a bad deal. I didn't even mention any of the utilities or HOA, so there's more expenses that you can add on there, but typically those expenses are the responsibility of the tenants. And so in this analysis, we're not going to look at the utilities and the HOA in this particular example. If it is your responsibility as the landlord to take care of all the utilities and the lawn care and all of those things, you need to make sure you're increasing the rent to account for those expenses. So for this example, let's say that we can purchase this duplex that's listed at $244 for $225,000. Now we're going to assume that we're going to BRRRR this property. If you do not know what BRRRR is, BRRRR, that is buy, rehab, rent, refinance, repeat. I'm not gonna get into it in this video because that's beyond this, but go check that out in this video and you can learn more about that strategy. That's essentially a way to avoid having to put 20% down on a rental property and to get a rental property pretty much without any of your own money. So go check that out if you're interested to learn more about that. But essentially what that means is that you're going to have at least 20% equity in this rental property. So it's a way to back into your 20% down payment as opposed to putting it as cash to yourself, right? So if we have 20% equity in this property already, that means that the mortgage on this property is going to be the remaining 80%, which 80% of 225,000 is 180,000. That's the first expense we're gonna calculate, is the mortgage. So using a mortgage calculator online, literally just Google mortgage calculator, you can determine what the principal and interest on this loan would be. And so in this example, it would be $808. So the next expense is your taxes and your insurance, right? So taxes are going to be found on your local county tax assessor's website for that property. So it's based off of the tax rate that you pay in your county. So in this particular one, our taxes are about $5,000 a year, which is about $417 a month. In my market, insurance is typically about $100 a month. So far, that's the mortgage, right? The principal, interest, taxes, insurance, PITI or PITI. Now the remaining expenses are going to be based off of the income, right? Your vacancies, repairs, property management, capital expenditures is a percentage of your income. So typically I always estimate based off of the quality or the age or if the property is rehabbed or not. So if it's a newer property, we can do a lower amount for vacancies and capital expenditures. Capital expenditures are your big ticket items. That would be like your water heater, the roof, flooring, anything that goes out that you need to replace during the time that you own this property, right? So you need to be accounting for these things so that you don't have to come out of pocket. If you don't account for them, you can literally wipe out all your cash flow in 1 year because of one repair, right? So you want to make sure that you're accounting for these items and putting money aside for it every single month. And so what we do is take a percentage of our rent and put it away. And so what I usually do is put about 5 to 10% for each of these things. We'll put 5% away for our vacancies, we'll put 8% away for our repairs, and we'll put 5% away for our capital expenditures, right? Because let's say that some of the big ticket items have just been replaced, so we don't need as much put away. We can save a little more of that cash flow. It's super key that you remember to account for property management too. Even if you're gonna manage it yourself, you need to account for it because obviously you're not gonna manage this property yourself for the rest of your life. If you plan to scale a rental property portfolio to many units, you're not gonna manage all these units by yourself. I would hope your goal is to have many units, so you need to be accounting for someone else managing it, even if you're managing it yourself. So we'll assume 10% for our property management expense. The deal needs to work accounting for all these things in the beginning from day one. So now we've determined our total expenses as about $2,052. Your cash flow is your income minus your expenses. So we'll take our $2,590 and subtract that from our $2,052 to give us a cash flow of $538 per month. So I know what a lot of y'all are thinking right now.
Tell them to bring me my money.
Slow down. We don't know yet if it's a good deal, right? Because it's gonna depend on who you ask, right? Because if I asked you, hey, do you want $538 a month?
What do you think?
What did it take for me to get that $538 a month? In other words, our COC ROI, right? Cash on cash return on investment. Essentially what that is the cash flow that you make that year over the amount of cash that you put in, right? So ROI is benefit over cost. So in this case, benefit is cash flow divided by your cost, which is how much you actually had to invest to get this return, right? And so that's what we need to look at in this situation to determine if it's a good deal or not. But remember, in this particular example with this duplex, we said we were gonna BRRRR it, right? Since we BRRRRed it, we essentially got into this property with no money down. Remember, if you don't know what the BRRRR is, please go watch this video so you can understand what the BRRRR strategy is. So we got into this property with no money down. So that would essentially be an infinite return on investment, right? Benefit over cost. If the cash flow is 538 times 12, which is 6,456. We divide that over our cost, which is what we took. In this case, it would be 0. That's, if you put that in a calculator, it's gonna say error, meaning infinite ROI, right? Because you cannot divide by 0. But let's say that we actually did put the 20% down on this $225,000 property, right? And so that would essentially be $45,000 that we had to put in to get this property. And then let's say we had to put down another $5,000 for closing costs. If you look at the annualized ROI in the case where we put now 45 plus 5, 50,000 down to get into this property, we have 538 times 12 divided by our 50,000. Now our return on investment is a lot smaller at 13% ROI. And so to determine if that's a good ROI, it's gonna be based off of you, right? You have to compare that to your other investments. So if you have money in the stock market, you probably are getting about 7 to 8% in the stock market. So that essentially means that if you put this money into this property instead, you could get a better return than you're getting in the stock market right now, which of course, I'm a big believer in real estate and the power in real estate besides just this cash flow, right? But that is a great return. 13% is still a great return. So it's still a good deal. The dope thing about real estate is that this cash flow is just your cash on cash return on investment. Your total return on investment includes all the other wealth generators of real estate that I talked about in the How Rental Properties Make You a Millionaire video, right? So we still have our appreciation. The property value is going up every year. We still have our equity build up as the tenant is paying that loan down, we're making money because that's getting added to our net worth. And we still get the tax benefits. That $6,000 that we'll make from cash flow in this year, well, you can pay no taxes on it because of depreciation. If we account all of that into our ROI, then it's gonna be a lot higher than that 13%. It'll still be infinite if you didn't have any money invested because you still don't have money invested. But even if you have that, if you account for the appreciation and the loan pay down and the tax benefits, then your ROI will be greater than 13% if you did put that 20% down. This is why I'm a big believer in real estate, and this is why I love real estate, because it makes you wealthy in many different ways. It gives you the freedom and it also gives you the net worth. Y'all let me know in the comments below, would you take the 538 per month cash flow? Think about it. If you had 5 properties cash flowing you $500+ a month, that's $2,500 a month. Think about how many properties it would take you just like this to actually achieve financial freedom, right? If you look at it like that, then it could be a great ROI for me. But yeah, that is it for this video. I hope y'all enjoyed it and got something of value from it. Please share this with 2 people that are looking to get into real estate as well. Y'all give this video a thumbs up so the YouTube algorithm knows that this is good content that needs to be shared more. I spend a lot of time and a lot of effort on these videos. That's all I ask for, really, just a thumbs up, man. I would really appreciate it. But yeah, I'll see y'all in the next one.